Working capital is the exact point where rigid accrual accounting rules collide with the messy reality of operations and managerial judgment. Standard financial analysis treats these short-term accounts as passive compliance checkpoints. Analysts run the current ratio or calculate days sales outstanding, tick the liquidity box, and move on to headline earnings. But these aggregate ratios actively compress thousands of individual transactions into a single, smooth number. That compression strips away vital context, allowing severe financial distortion to hide in plain sight. Management under pressure turns to working capital precisely because it is transaction-heavy and deeply reliant on estimates. Adjusting inventory valuation or tweaking an allowance policy shifts the financial picture quietly, bypassing the immediate scrutiny that accompanies top-line revenue manipulation. Reducing working capital to a simple liquidity test leaves you blind to the actual mechanics of fraud. It ignores how companies engineer synthetic demand and suppress the visibility of their own liquidity stress. Look at the math behind days sales outstanding, a stable 45 days. This average hides reality. A massive influx of new sales artificially inflates the denominator, masking the 90-day uncollectible debt rotting underneath. To strip away that mathematical camouflage, we must use aging migration analysis. When balances repeatedly migrate into older categories without settlement, you have proof. The original revenue was recognized under conditions completely detached from actual collectability. A late quarter surge in invoicing volume serves a dual purpose. It hits the revenue target and acts as a mathematical weapon to mask structural decay within the aggregate ratios. A trade receivable is the unresolved economic consequence of a revenue recognition decision. It is the financial afterlife of a claimed sale. To detect acceleration, we map transactions chronologically against the reporting boundary. Watch the massive invoicing spike in the final 72 hours before close. Tactics like channel stuffing drive this paperwork, yet physical shipments remain flat. Immediately after the boundary, credit notes and returns cluster severely. Because this revenue was forced into the ledger to meet a target, it lacks commercial substance. The evidence of that weakness survives entirely within the receivables ledger. Analyzing chronological transaction clustering allows us to effectively separate genuine commercial demand from target-driven, highly synthetic revenue generation. Gross receivables represent the company's formal claim against its customers. The allowance account represents management's realism about what will actually convert to cash. Executives under extreme performance pressure protect current earnings by delaying impairment. Look at this top line. Gross receivables in the 90-day buckets are climbing rapidly, yet the corresponding expected credit loss allowance, the bottom line, remains completely flat. That expanding space is quantifiable hidden credit risk. A company can deploy highly sophisticated expected credit loss models and still effectively hide risk. They achieve this by selectively ignoring historical loss data and refusing to update forward-looking macroeconomic assumptions. A stable allowance ratio during a period of worsening aging migration proves that a company is secretly warehousing risk. They are preserving the reported profit margin by refusing to acknowledge commercial reality. Financial manipulation cannot be indefinitely contained within a single account. The physical constraints of the business force the pressure out of receivables and into other areas of the balance sheet. We map synthetic growth using the operating triad. Management artificially pushes revenue, causing customer debt to bloat. Costs are deferred into inventory to protect margins. Supplier payments stretch abnormally. At the top, a glowing reported profit. At the bottom, operating cash conversion halts. An isolated anomaly in one account might have a benign operational excuse. Interconnected anomalies across the entire triad are the fingerprint of deliberate manipulation. When reported profit persistently diverges from operating cash conversion across the entire triad, the financial narrative has broken down. The earnings are an accounting fiction. Financial statements often look their absolute best when management is under intense pressure to impress the market. Then, the polished surface shatters. Routine-looking balances in working capital are inherently dangerous. They offer bad actors the ultimate concealment within normality, allowing severe distortion to masquerade as ordinary business rhythm. Rigorous financial analysis requires viewing working capital as a dynamic chronological record of management behavior, rather than a static year-end snapshot. Stop trusting aggregate ratios. Test the true economic substance at the cutoff boundary. Cross-link the entire operating cycle and unearth the truth hiding in the ledger.